Hello, everybody. So the market pumped today, as we say. And the problem is I don't like expensive stocks, and now relatively they seem expensive. Of course, they're much cheaper than they were a month ago. But after that bounce, it sometimes feels uneasy to buy stocks, for what, 12, 13, 20, 25% more than you could have gotten it yesterday. Hence today's video. 4 stocks the rally left behind. 4 stocks that the rally forgot about. And so these 4 stocks, to no surprise if you follow the space, they're in the healthcare space. And the first stock that got left behind in the healthcare space was LifeMD. So LifeMD is IM's baby brother, and you can see it was only, that sounds crazy of me saying that, it was only up 8% today, which is nothing at all. IM's was up much more, more than 5% extra. I closely follow this pair because I like both companies very much, but it's a matter of which one do I want to invest at any point that I have money available, which do I prefer. Right now, I still think HIMS is cheaper on a risk-adjusted basis. But if you look at HIMS, and if HIMS ends up crossing 35 again, and let's say LifeMD stays near the $5 range, I might think that LifeMD will be cheaper. Then you may remember when HIMS rallied towards $72, I was buying LifeMD because LifeMD had only rallied to like a 750 or like a 7, and HIMS was at 70. So the delta between those two, the valuation ratio between those two was too wide. I still think it's in the advantage of HIMS, maybe in the advantage of LifeMD soon enough in the future. Key differentiation from HIMS, LifeMD, if you're curious about this stock, LifeMD is just like HIMS. It's a digital doctor. It's a digital pharmacy. They are building their own facilities now, and they're going to launch their own warehouses where they're going to ship the products themselves. Before that, they've used coupons. They used coupons before that, and you could get the pharmacy prescription anywhere with a coupon. They also don't accept health insurance, but they accept pharmacy benefits. So that's a tiny distinction of LifeMD, a small distinction. And another distinction is that because they accept pharma benefits, they try to get your pharma benefits to pay for the meds, and they're more interested in selling the doctors, and their moneymaker is what I call the Netflix of doctors, which are their subscriptions. And so for $39 a month, you can get up to 1 office visit with an actual MD per month. And so for people who have medium health needs, as I call them, for people who see the doctor like every month, this is a very valuable offering, and I like LifeMD very much, although right now I still think HIMS is a tad cheaper. Let's move on to another stock. It's TG Therapeutics, TGTX. They are the maker of Briumvi, and I covered this stock quite a bit, a few months back when I entered the position. I was very pleased to see it drop from the low 40s down to the 35s. And again, it seems to me like no reason but the sell-off is why the stock dropped. They needed to sell and it hadn't dropped that much. So I think a lot of people sold that stock off. But this stock looks good to me. They make Briumvi. So Briumvi is the last and final FDA-approved treatment, although doctors are typically don't like to use the word cure treatment, so we call it a treatment, but it's kind of like a cure for multiple sclerosis. And so there's 3 modern day treatment that have been approved for multiple sclerosis. It's Briumvi and the 2 competitors. So they're kind of a triopoly, and the FDA said no more. We're not going to approve any more treatment. You go ahead and make money now, is what the FDA said. And so Briumvi priced itself as cheaper and requiring and the product is better than the competition. Of course, this is something for a doctor to decide, but it requires fewer injections, less time at the MS center, and it's also cheaper, and so insurance like that. The cost, I think, of Briumvi is something like $55,000 a year, something like that. Anyways, there's 3 of them. 3 of them have been FDA approved, and they can now rent seek. And in the case of BMV, this rent seeking can happen until 2032. And I'm comfortable. I mean, I don't like rent seeking on this channel, but I'm comfortable with BriumV because they are the cheapest option out of all three competitors. They are the cheapest product out there, and so I think they're going to take a lot of market share. Also, note, oftentimes many of the companies I cover, a big risk of a healthcare company is Medicare stops paying, right? Or Medicare stops covering you. And if Medicare stops covering you, because most insurance companies in the US follow whatever Medicare does, they also typically wouldn't pay. The good thing that I like about it's awful to say, but multiple sclerosis. One of the very unfortunate thing that I like about it is that it's a debilitating disease. It's not like people can do without treatment. It's like if you have that, it's literally the wall of your nerves will literally start melting, and the insulation of your nerves stops working. It's one of the most painful things that you can get, and that's why treatment is absolutely needed. And when people get a MS diagnosis, they get treated, and insurance pays for this because this is a really bad one, unfortunately, but fortunately for BriumV because they sell in that market. Anyways, they're predicted to grow 70%. That's my lowball growth number analysis. I think they'll do more. Gross margin is 88%. EBITDA margin is already there at 15%. Enterprise value over gross profit over revenue growth is a 0.29. This stock is cheap in my view, and it achieves a rule of 40 in the form of 85. It's a rule of 85, which I find quite appealing. Moving on to a third stock, which is Biostem. Biostem is still the stock that has gotten me the funniest comment on the channel, which is, I'm not putting my money in placentas, bro. I thought this comment was hilarious. Anyway, it's not as funny now because we're used to it. But why not? Why wouldn't someone invest in placentas? Placentas are great. They're filled with stem cells. People throw them away. It's a free resource. We should do our best to actually use placentas, and that's what Biostem is doing. Biostem is using placentas, and it's turning them into, for lack of a better word, I'm gonna call it bandages, right? But it's the word doctor uses. It's a wound care solution. It's a dressing solution. I'm gonna call it a bandage because it kind of looks like a square bandage. But anyways, this stock Biostem, it fully participated in the crash. It gets a full participation trophy for participating in the crash. You see, down 57% from the February peak. So congrats, Biostem. You took all of the selling you took. Zero rebound. They've literally had zero rebound. They have not rebounded. And this is unfortunate in my view because I see this, I think this company has a lot of opportunity. There's a lot of risk, and the big risk is, it seems like two of their products are not in the local coverage determination. So that means that two of their products may not be covered potentially, and we'll know more on the call. But I mean, the risk, because of the valuation of that product, I think the risk is more than accounted for. The products, look, gross margin is 97%, right? 97% more gross margin. Why? Because the cost of goods sold, I mean, it's donated placentas. Like they just use donated placentas, but I assume they get them for near free. It doesn't cost much, and they turn these placentas into bandages that have wonderful thing for wound healing and wound care, and it makes sense because placentas are full of stem cells, and stem cells are, there's lots of applications for them, and maybe that's a risk. 5 years, 10 years from now for Biostem, maybe that's a risk because there's a lot of people competing for placentas, and women start asking for money for their placentas. Maybe that's a risk at some point, but for now, that risk is not there. And they turn these placentas into fancy bandages that have a lot of benefits. I see, and of course, there's competition. So let's talk briefly about the competition. From my best understanding of this and discussion with my in-house doctor, the big disruptor here is the wound care business, the pig business. So a lot of very advanced wounds are treated with processed pig skins, and of course doctors have a bunch of fancy words to sell those, and they don't call them pig skin. I can't remember what they call them, but anyways, but it's made out of pig, and that's like the main thing that that they use right now. So this is going after that. This is disrupting bandages that are made out of pig's skin. So that's point number one. And you may think, oh, okay, all right, fine. I'm fine having a part of pig skin, and to recover from my surgery. Yeah, that may be fine. But there's one huge market that I think of that I didn't analyze the first time I covered, which is the Muslim market, right? I can't remember how many Muslim people there are in the world, but I think something like 1.4, 1.3 billion people. Whoa, when I started thinking about it, like, wow, that would be a huge market. They, in my view, they would definitely prefer the placenta-based, although, not exactly an expert, but I maybe this is halal, right? Maybe this would be halal to have a placenta bandage. So that could be a huge market. Okay, that's point number one. Point number two, another big market. We don't need the Muslim market. Another big market for this is the diabetic foot ulcer. And diabetic foot ulcer is one of the major complications that people with diabetes get. And that could be a huge market, and that would open up a lot of medical coverage, a lot of coverage from Medicare on this, because of course diabetic foot ulcers are very expensive, and they're just wounds on your feet that do not heal for months. And again, don't look this up on Google. It's a very unsavory thing to look at. But anyways, if you do, you'll see why I think this company has a lot of potential. The point here is the valuation. Of course, there's a lot of medical companies that have a lot of potential. A lot. But on this channel, often, I look at valuation. And this is the cheapest stock I ever found in my spreadsheet. In the history of my spreadsheet, no stock has ever been this cheap. Enterprise value over gross profit over revenue growth is a 0.005. So that's about between 4 and 8 times cheaper than LifeMD. And LifeMD is the cheapest stock that I found. So and you can look at those numbers. Trailing 12-month revenue is 302 million. Enterprise value is 120 million, right? Market cap is 130 million. So you have 130 million market cap, 302 million of revenue. Forward revenue growth number, maybe it's going to be less because of the LCD. And them not being on an LCD for 2 products, maybe it's going to be less. But you know what? At this point, even if it's flat, I mean, this stock is so dirt cheap. I'm willing to accept a lot of issues for this stock, given how cheap it is, and it's very, very tough to believe that this stock could be so cheap. And I think one of the main reasons why this stock is cheap is, of course, there's a catch. You can't buy it at most brokers. Most brokers don't have it. It's a pink sheet, as they call it. Right? So most brokers don't have it. There's very little volume. Very little volume. Like I bought it the other day. I think I must have been the only bid. Or something like that, or next to the only bid for buying the equity outright. And anyways, I like this stock very much. I look forward. I think this stock could become popular if it gets listed on the Nasdaq, and I look forward to seeing how that story unfolds. Stock number 4 now is CoreMedix. So CoreMedix. Oh, I didn't put the chart here. I forgot to put the chart. Anyways, CoreMedix has not recovered. It's way down. It's been way down. And it bounced. It bounced 2 days ago. It bounced because they listed their preliminary revenues, which I haven't updated here, by the way. So the stock bounced. Market got very optimistic. They were very happy, and then it lost it all again, and it has not recovered. It lost it all again, and it has not recovered. So this market, one of the reasons for the drop at the last earnings call, and this stock dropped 30% of the earnings call, was because there was some delay at one of their big customers, with onboarding one of their big customers. There was some delay, and that means that a lot of the growth was going to be in the second half of the year. And of course, Wall Street, as of this week, it seemed like it only cared about the next hour. Usually Wall Street looks at the next quarter, and so they didn't like it, and so they dropped the stock. But to me, the fundamentals on this company are strong. What is the product? The product is a catheter lock solution. It's a little liquid that you put inside a catheter. Now you may ask, how big of a market? How big are these CVC catheters, central venous catheter? Well, they're actually huge. every person who goes on dialysis, and dialysis is a part of kidney care, that's towards the end of diabetes. Anyways, so they go on dialysis. Like if you get really, really bad and you have loss of kidney function, you have to go into dialysis. And one of the big problems of dialysis in the past was that you would get infections in the catheter. And if you get an infection in the catheter, well, guess what? It's $100,000 hospitalization and something like odds of dying of like 70% or something absolutely awful. So the last thing that people who go on kidney care, right? The last thing of people who go in dialysis, the last thing they want is to get an infection. Infections is a huge metric, trying to not get an infection, and that's why this product, which you need 2 vials, and to the best of my research, it's about $250 a vial. This product is used by people who need to go on dialysis, and Medicare pays, because Medicare do not want people to have an infection, because if they have an infection, it's way more costly for the system than if they don't have an infection. And I think like the average treatment of a dialysis patient, I think, is 9 months. That's your average treatment. So think about the return, right? It's worth for Medicare to pay it's worth for them paying $500 a week whenever they go in for dialysis. It's worth for them paying that if it avoids the risk of a costly hospital stay. And so that's why I think this product is more safe than most. And it's also ethical. There's a lot of good things. And the big customers, the 2 potential big customers, are Davita and Fresnicius. You may have heard of Davita. I'm pretty sure it's owned by Warren Buffett. So Warren Buffett thinks it's a very profitable business to be in the dialysis care business. And of course, these centers also make money based on how few infections they get. So these centers have an incentive to adopt the product. So I really think the product is very compelling, and the analysts agree with me. When I look at the analyst number, the analysts are saying, they're going to grow sales at 140%. So that's a lot. And so if you adjust that for growth, enterprise value over revenue, or gross profit over revenue growth is a 0.06. Rule of 40 is a 208. Now, be very careful with these rule of 40s on all of these, because, a lot of it is based on the growth rate, which I assume to be outstanding for many of them. But if you look at CoreMedix, look at this. They're even optimized for our EBITDA margin. I mean, this is ridiculous. Like 28% EBITDA margin. They're on their way to being, super profitable already. So I love these 4 companies. I think it's a blessing that they didn't go up. And, hopefully you enjoyed this video. Don't rush to buy too fast, because I want to buy. So anyways, hopefully this stock stay down for a little longer. This was not investment advice. This was not financial advice. This was just entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.